Welcome to Trading Trends. This is Ilya Spivak, head of Global Macro here at Tasty Live, with a very special guest. Samantha LaDuc is with us of LaDuc Trading. Samantha, welcome.
Thank you so much.
Well, let's go right to the heart of the matter here. The stock market hasn't done anything since mid-May. It's drifting at the S&P, it's drifting at the NASDAQ, but that's not the whole story now, is it?
No, we have a really nice rotation going on underneath the surface. And I have a saying, in lieu of sector rotation, there will be volatility. And right now, volatility has been nicely suppressed, especially post FOMC into options expiration on Friday. But for now, the rotation underneath the surface has been out of semi-memory kind of super cycle trades into the hyperscalers that had been kind of left on sell support. And basically, they have started to get a lift. And that's very, very supportive. Also, some software plays, also the Chinese ADRs. So basically, we've had a rotation after an outsized Q2. So Q2 showed SOXX, the semi ETF, one of them, a 100% advance. And that's not a double or triple ETF. That is just the SOXX pure play. And it is also the NASDAQ 100 QQQ had a 30% advance for Q2. So we're talking, trough to peak, April to June, and that's a lot. So what we're having right now is some distribution. The top line indices are staying relatively flat in kind of wild chop intraday, but otherwise not breaking now down, not breaking out. And we've had a nice pullback despite the earnings beat. They are crushing it, right? NVIDIA crushed it. It's still sold off. Micron crushed it. It's still sold off. Samsung in South Korea, oh my goodness, they had a 19-fold profit margin increase year over year. They still sold off. Taiwan Semiconductor today, also, everyone's long. So the theme was everyone's long. And now there's some profit taking. The bulls are kind of getting a little case of vertigo, looking down. We also are looking at a Q2 earnings quarter reports now, where the hyperscalers had been sold beginning of the year, but especially on this manic run in semi and memory and solar and space. All of that has come into distribution, and hyperscalers are now catching a support bid into their earning prints.
Well, this, of course, makes for a really interesting backdrop, right? Because we had in the first quarter all of these incredible numbers that the hyperscalers told us. We're going to spend this many billions and all this money, and the market almost perfectly on the eve of earnings season took its eye off a war happening in the Middle East and said, right, the bonds can go do their thing and gold can go do their thing and the dollar can, but we're going to look over here, because these hyperscalers are going to say all these big things. And of course, there they were. Now the expectations after this massive run that this inspired are very, very high going into this earnings season.
Correct.
How high is this bar, and can we clear it?
Well, I really think that this is it for now, meaning we've had this scarcity versus abundance narrative for the entire AI mania. So in other words, all the bottleneck trades that you're talking about, right? This is the rotation that we collectively, investors, plowed into, like we did for gold and silver 2024, 2025. Well, this rotation into semi, memory, photonic, all the bottleneck trades, also as a result of the Iran war, is now, like I said, going into this case of prove it, right? Meta says we have excess capacity we're going to sell. They came out with that a few weeks ago. We have some of the largest data centers that are losing their sponsors like BlackRock, or the city of New York saying we're going to put a moratorium on data centers. Actually, it was the state of New York, excuse me. So we have some of this excitement, of course, in South Korea. The Kospi has been driven by outsized earnings bubble in Samsung and SK Hynix. And then as soon as we have SK Hynix, a list here in the US, and we have SpaceX finally come to market, we also have liquidity that is now able to leave the market. So I think right now the AI exhaustion into a potential summer storm, I still see potential that Iran risk is not really priced in. We're going to talk about oil, I'm sure, but also the dollar yen. That's something that is threatening, that can also put a pause in this AI memory super cycle.
Well, let's go straight to dollar yen, and then we'll round the corner to oil, because that's obviously one of the big drivers here, especially with what's happening with Fed policy expectations, a can of worms unto itself. But let's talk about dollar yen here. So we're looking at the yen at the weakest going back to the 1980s, mid 1980s. Just a staggering dollar rally, especially against the yen. Explain to the folks what the danger is here.
Well, we have a few reasons while this is underway. Obviously, we've all heard the yen carry trade unwind risk, but it has not occurred since July of 2024. And we really would need a decoupling by Japan in their energy dependence on U.S. oil and gas, but also the petrodollar, because they're the ones who are very helpful in keeping demand for dollar and U.S. treasuries in play. So we have a huge rate differential between the Japanese interest rates and ours, which is why the Bank of Japan has a bit of a Fed problem. So as we are not cutting right now, it looks like Bank of Japan will continue to have elevated inflation from the energy complex, right? Oil, war is inflationary. Rising oil is very inflationary, especially for an importing company, a country like Japan. So we really have this risk. It's not a present risk of the yen carry trade unwind. It's the reversed. It's the dollar yen getting very, very bid and the yen falling, which puts a bid in the US dollar. And it's that combo of the rising dollar, rising US yields, and rising oil, which can also be a headwind to equities. And if you notice, the dollar started rising up from the bottom pretty much when Fed Chair Kevin Warsh was nominated by Trump. And it stayed very, very bid all the way through the FOMC meeting. We've also had the 10 and 2-year yield curve that has undergone a very strong flattening into the FOMC, and it has since steepened. So right now the yen is falling, the dollar is rising. This reversal would cause a lot more equity disturbance, but it's not right here, right now. It's more of a later in the end of the year after Iran escalation risk passes, when Japan can actually kind of narrow this widening rate differential situation, and where they can also honestly become less dependent on U.S. oil and gas, and specifically the petrodollar. So I think for right now, we're not really in a situation where Fed Chair Warsh is going to raise rates aggressively. That would be just shooting ourselves in the foot. We already have 10 trillion of short duration T-bills that need to be rolled. So rising rates would be very expensive. And that would really trigger much more inflation. And that's not something that you do with a country that's right now in fiscal dominance. So I think there's a lot of hawkish talk, but it'll be very, very hard to follow through with that walk. So right now, my focus is on the dollar. And as it bids up higher in the short term, with the dollar yen, I think we have more headwinds coming for a summer storm temporarily until we can get through this Iran oil spike, which will be very, very inflationary in the short term. And then after it falls, we'll have a deflationary impulse. We'll talk about that another time.
Well, so this is, I think, a fascinating set of circumstances all coming together. Obviously, we've had all kinds of U.S. monetary policy inputs for the calculus this week. Warsh was up on Capitol Hill 2 days back to back. We had a pair of weaker than expected inflation numbers. CPI was negative month on month, so was PPI. It was mostly energy, not surprising. But the tone from Warsh, I mean, if we thought the president wanted a rate cutter, that's not what he sounded like. And so there's an interesting thing that's distilling into the price action from all of this. I wonder what you make of it. The bonds have been a little jumpy this week. They had one reaction to CPI, then they heard Warsh and ran away. Then the next day, things changed. But one thing that has been steady through all of it, gold was not really listening to him, it seemed like, and is trying to bottom after this very strong sell-off as you've been saying, in the wake of the war and its impetus for inflation. Higher rates, stronger dollar, obviously not great news for gold, so it's been down a lot. Is gold telling us something here? Is gold trying to say all this hawkishness is just smoke and mirrors?
I think gold is not the path to follow for this. I think the dollar yen is a closer intermarket or correlated asset. But first, Warsh. So I really do not believe that he will have more than or guide for more than one rate hike, if at all. So this is something where he's talking very hawkish about inflation, having control over this inflation narrative. We right now so far still have a labor market that is relatively firm, but I think he's counting on the AI productivity gains to help with this deflationary impulse that's coming. And he's obviously supporting Trump and Bessent leadership as it relates to oil coming back down, price of after they still are looking ahead, right? In other words, taking control of Carg Island or what have you is on the radar for getting control of oil prices. I think it'll be very dangerous until this passes. But in the meantime, they are still talking hawkish about being in control of inflation, not necessarily hikes. So I don't spend so much on the different Fed heads now because of speakers, because they're really not with a great track record. This is true, but I mean, this is proven. But I also think that we have some potential for not just CPI softening because of that lagging effect of energy prices, but also shelter prices are falling. And that's really a lagging impact on CPI and such, and producer prices. So for right now, I think that we have this yield risk of short-term higher with dollar and oil, but ultimately we do have the higher potential of a deflation risk later. So oil coming down, dollar coming down, not right now. That's when gold starts to perk up. And gold for me is still a short. I warned January 22nd before the very large 36% peak to trough pullback in 2 days for silver and 16% in gold. And then when it happened, I said, that's it. We've now run this mania so high in a parabola that parabolas trap longs, they trigger volatility, and liquidation events. And now bulls are going to be disappointed. It's going to go nowhere fast for the rest of the year. So, and it's gone nowhere fast. It's still falling. Continuous contract, 3,500 gold will be bought with both hands. But until then, there's no trade. And you also have the war that caused some countries like Russia and Turkey to sell gold. Prior to that, they were all quickly accumulating and bypassing the dollar to do trade, right, in gold outside of the dollar. So one of the reasons why I think this escalation in the war is very worth watching is because there is an attempt by the administration to stop or slow de-dollarization, and I think it's a risky one. So for right now, we have our mania in AI. We had our mania in precious metals, peak, rollover. It's still without momentum. Now we have the AI mania, which peaked and rolled over. And I don't think it's going to pick up speed again. In fact, it's going to test the bulls very soon. Micron's already 30% lower from earnings, right? Taiwan Semiconductor, the whole ecosystem has been really sold in the past month and a half. So now we're going to get to a point at some point where bulls are going to have to step up and say, yeah, I think this super cycle is still in play, because if it is not, we will have much more selling, right? So this is what happens when a parabola breaks. We've seen it with gold, and we're seeing it right now with the AI mania.
There's a very interesting echo there. Last year, and this is exactly what you're referring to, gold became less of what we would normally look at as a sort of foil for the dollar or a foil for interest rates, ignored everything, and became almost like a speculative narrative unto itself, separate from what's going on with stock markets, separate with what's going on from everything else. And then, of course, with a violent reckoning after. What's interesting in this environment is that all of it seems to be hinging at the same time on, first, the inflationary impetus from the war and trying to make sense of that, because geopolitics are, of course, much more difficult to keep hold of than economic data. You get a tweet and then everything changes, and then 24 hours later you get another and everything changes again. But for now, and you've pointed this out, I should say, before it started, I think you and I might have been looking at the same thing. Crude oil started to find a bottom before Iran re-engaged this war.
Correct. Mm-hmm.
And now we have this pop. It's kind of anchoring at these levels. Do you think we're going to keep going higher here? And how does that complicate this situation? Or do you think we've just reached a new level of kind of frozen conflict where neither side wants to escalate too hard, nor do they want to stop shooting?
So it's a lot easier for me to talk about oil, dollar, yields, market direction, sector rotation, and stocks than it is to get into the head of Trump, Netanyahu, and any political, comment as it relates to geopolitical risk. I can see that we obviously had oil fall into the pre-Iran price gap. And then it quickly got supported when the memorandum of understanding became the misunderstanding, and all things started again, which everybody could have predicted, because there's no way that Netanyahu's done and there's no way that Trump is done. But the timing of that bounce was in question because we still have midterms, right? Summer driving expense and voting right ahead of the midterms. And then, of course, Trump has already said, for 40 years that he wants to take Iran's oil. This is not a new idea. And I don't think this is done. I don't think this is done. There's going to have to be a major macro event risk that ends this war. Otherwise, it's going to be protracted. And then we will have actually a feeling of this oil effect. We didn't actually have any because we had the inventories and we had manipulation also in the futures market. But we really haven't had a pricing in of an oil shock. We haven't. I'm not talking about the price of crude, for example, but I'm talking about impact on the real economy. So that hasn't been felt yet. If we feel, I think that this is an oil bounce right now that's currently underway into 85 easily, overshoot to 91, and then that's where it likely gets rejected and comes on down. But if it doesn't, and we go into a very big escalation, then all bets are off. So that is very hard to tie. I mean, right now, technically speaking, and from just a standpoint of very predicted bounce into 85, potential overshoot 91, we're going to go at some point in the future below 65 again. And 65 is a 20-year line in the sand, even longer, where it's bullish above and it's bearish below. And this is in large part a supply-demand question. And we do have falling global oil demand. So right now we have a supply interruption, which is impacting price. But big picture, not just talking about China mandating, right, electrification and this rotation out of fossil fuels in large part and into solar and alternatives. For sure, they have mastered this. And now 50% of ground transportation is EV. We are not anywhere close to that, right? We're maybe 10%. So the point is they're in a much better position with falling energy prices. We derive a lot of economic impact from energy sales to Europe and beyond. So the fact that we have right now a bid oil complex and especially amazing margins in crack spreads for refiners doesn't mean that's going to last into 2027. So 2027, we very well could see this falling global oil demand overtake the supply disruption. But that's a macroeconomic underpinning. And that would also be very, very, by the way, helped with a falling dollar. Right now, we're not in that. Right now, we're in a regime, right, this year of rising dollar, rising oil, and rising yields. So I'm talking more of next year. But right now, that's the risk to the AI momentum. We've lost the momentum. So scarcity versus abundance, we're now looking at the question of earnings really showing productivity gains, and some will, and those will be the winners. And the rest in the AI space is as good as it gets. And bulls are getting a case of vertigo and looking down. So I think we have to kind of parse those two, mania versus macro, and both matter right now.
That's a very, very important insight here because something that's been happening that I've been talking a lot about is the mismatch in the way that U.S. economic growth is being created in this environment. Obviously, the consumer is 68% of the economy and is by far the largest driver of GDP in normal times. What we saw in the first quarter was the consumer had the smallest contribution to GDP in something like 3 years. Meanwhile, GDP still rebounded from that government shutdown a quarter in the fourth quarter of last year. It only came back about halfway to where growth was before that shutdown, 2.1%. But it was almost completely driven by the investment component of the economy. And that's not even the AI boom as such, because you just mentioned there's all this opposition to data center building now. But of course, all the builders are stocking up. They're getting ready. They're getting their inputs together. We've seen the manufacturing PMI numbers booming around all of this. But of course, when you overclock an engine that's only 14% of the economy, that's going to be inflationary. And that's going to squeeze consumers. And so there's this strange thing happening where on the one hand, the AI boom is what's powering the economy and creating growth. But on the other hand, it's also the thing that's squeezing consumers, which are a much bigger part of the whole. How does that distill for you in terms of sentiment versus sort of the underlying macro reality? Are we looking at a recession risk next year if this continues this way?
First, I think we still have three legs of a table that are pretty much holding up. So in other words, this AI ecosystem with tons and tons of CapEx spending helps this economic boom. Also reshoring, forced policy, right? Policies dictate price, tax cuts for corporations. They can write off massive amounts as long as they are obviously, coming back home. So the combination of the AI CapEx spending, the reshoring, and also we do, you're talking a little bit about the K-shaped economy, but the wealth effect where folks that have benefited from the inflationary assets, whether it be the stock market, their homes, their businesses, they are also earning lots of interest on their cash. And that's also helping this backdrop of, unfortunately, the haves and have not, the disparity between the income earners, wage earners, which has not grown, and the assets, which are inflationary, which have grown. So we still do have a lot of wealth, is what I'm trying to say. We have a lot of wealth in the system. And by the way, we also have a lot of outside influence to our market and our inflationary backdrop. In other words, foreign countries are buying our dollars so that they can invest in the AI ecosystem that is our stock market. They're buying treasuries. There's, in some cases right now, they're buying our oil and gas because that's kind of what's been, manipulated. So we still have a lot of our own, and also countries that don't have access to capital. Think Europe, right? You got to go to a bank to get your new idea funded. Here, oh my gosh, the trillions in private equity and private credit, right? So they're coming here also with their ideas. This is why the US has excelled in innovations, but also the stock market advance. It's a little Wild West. There's tons of financialization. I can say a bunch of stuff about, the grift and the corruption. But the point is, we still have a foundation of wealth, a foundation of attractive access to capital. Yes, a foundation of manipulation and financialization. So that's obviously debt, which is bad, and at some time it's going to rear its ugly head. And rate hikes are not going to be friendly for that. A constrictive Fed is very bad for liquidity, and that's also what topped the 2000, right? It wasn't just the parabola and the mania, but it was also a tightening Fed. And people forget that. So I think right now we have the what was I said this morning in my live trading room, 82% of fund investors are long semiconductors, okay? The long global semiconductor trade is the most crowded trade ever. right? It's not, we've had long dollar, we've had long gold, but we've never had this concentration risk of AI just captivating the world. And long story short, when they leave, when money goes home, based on tightening rate differentials, based on falling value of the dollar and petrodollar, then we'll end yen carry trade unwind when they start to have some really underpinnings of macro shifts and these leveraged ETFs, which are weapons of mass, destruction to retail. That even, by the way, the South Korean regulators today came out and said, "Oh, we're going to stop allowing these in because they're creating mania that then triggers margin calls," right? And then they had their largest sell-off on Monday, et cetera, et cetera. So this is going to continue basically as a backdrop. In other words, sadly, grift is bullish, financialization is bullish. But this is all the money flow that drives margin debt. And then once we trigger these parabolic volatility liquidation events, then it shakes out the weak hands like the gold and trend gold players are not leaving, right? None of their arguments have been negated. The fact that we've fallen from 5,600 to 4,000 in gold. Come on, they're just looking for a time to buy in. Well, the AI super cycle right now is coming under distribution and selling, and it could be severe. Depends on your bull bear case. We don't know yet. Will they step back in and defend? So we're going to get to a point this year, Q3, Q4, most think it's not going to peak until the first half of 2027. What if it peaks earlier? So my point is we haven't really tested the AI memory hardware, semi, super cycle. Everyone is still long.
Join Club to trade with Samantha. Scan this QR code or click the link in the description.